So, which one's better, houses or units for property investment? I get this one every week, and I've probably got it every week for the last 15 years. So, let's unpack that today and have a look through it. Let's have a look at two key areas. What's better from an investment point of view, but also how do lenders look at it? Sometimes it's not the answer that you think, but it depends a little bit more on the individual property and what that property is doing and the math and numbers for that specific property. What we need to have a look at is what that property looks like from a serviceability standpoint, what that property looks like from a rental return standpoint, what that property looks like from a capital growth standpoint, and ultimately how all of these things combine and how that's going to affect your investment property portfolio and how this comes together to help you achieve your goals. So quite often I'll see property investors go down a certain path. They'll either be house focused or unit focused. And the reason that they're one or the other is because they only consider price and yield. Okay, now lenders don't care so much about price and yield. What lenders care about is risk and cash flow. So you have to remember, what determines your borrowing power is income, expense, rental income, and outgoings. Now, not all houses have all of these things perfectly, and not all apartments have these things perfectly. So what we need to do is kind of unpack the things that we need for our servicing calculations and whether they present in either a house or a unit. So what is it that banks might love about each one of these asset classes? Well, for houses, they generally have higher land content, which then leads to overall long-term capital growth. They have the ability to be improved without the need for the whole strata to want to paint the outside of the building. You can individually improve the valuation on your property by doing works within your property. Now, all of these things typically lead to better liquidity in a quicker time frame with houses. Now, if you're a lender and you're lending against this asset, it makes it pretty appealing. Now, how do banks view units? Well, all in all, they view units somewhat similar, so long as they are good, well-chosen, owner-occupied stock within certain areas. So all things are not equal when it comes to units. If you're choosing owner-occupied style units or really good investment style units in an area that has employment, in an area that has education, in an area that has medical, in an area that has access to transport and a high desire for people to live in that area, then you're going to be fine. In fact, probably as good as buying a house. But if you then take into consideration the types of units that lenders don't like, student accommodation, high density, very small units, under 50 square meters, then you skew away from units back towards houses. So it's not so much about units, it's about the type of unit that you're trying to invest in and whether that type of unit is going to be acceptable or palatable for a lender. The next thing that we need to unpack is which of these two asset classes are better from a debt servicing point of view when taken to a lender. Now, it's not hard and fast. A lot of times when you look at units, they win hands down. Their rental return is usually much higher than a comparable house land. Now, why is that? Well, renters typically rent a number of bedrooms, a number of bathrooms, and a number of car spaces. Now, when you have a unit, all of that is on a very small parcel of land, and therefore your rental return is usually a whole heap higher than it would be on a big block of land with a really small house on it. Now, the thing that usually holds back your net income on a unit is because you've got to pay things like strata. Now, obviously, the higher the strata, the more it is going to take out of your rental income and lessen your net rent. So apartments that have pools and gyms and lifts They sometimes can have quite high strata costs, which means your net return gets diminished. But you've got to balance that up. In a lot of states and territories in Australia, land tax is just a bigger problem as what strata is. So a bank is looking for what is the income of the property, what is the expenses of that property, and what is the net income for that property. Quite often, if you buy the right unit, you'll actually have a higher net income after strata taken into consideration than you would if you bought a house, especially if it's a small old house on a big block of land, and that big block of land comes with hefty annual land tax. So it comes down to how much can I borrow against these two asset classes. And as previously discussed in the video, the devil's in the detail. What we need to do is look at what type of apartment we are looking for and what type of house we are looking for. In terms of the apartment, having something that has massive strata is obviously going to take away from your net income. But if you can find yourself a good owner-occupier style apartment or townhouse that doesn't have massive outgoings in terms of it's not servicing gyms, your strata's not maintaining pools, it's not maintaining lifts, it's not maintaining very high-rise buildings that need a lot of external cleaning or external painting. If we're looking at a low set owner-occupied style apartment or townhouse with reasonable strata, usually you can find those that will give you a good return in terms of a net return, but also with a reasonable size land footprint that will give you owner-occupied style capital growth over a longer period. So you're looking for a jewel in a crown, but they do exist. A lot of it comes down to what to avoid. We know that we're avoiding high strata. We know that we're avoiding low amounts of land content in our purchase. And we also know from a debt servicing point of view, we're trying to get those ideal set of numbers combined with the right type of property that will be palatable to a lender and give us a good loan to value ratio for the purchase. No high rises that might have loan to value ratio restrictions. When it comes to houses, we're looking for a bit of a balance there as well. Typically, houses, massive blocks of land with high amounts of land content that would have high amounts of land tax are not what we're looking for either, especially when the house that sits on top of it is a tiny 2 or 3 bedroom that doesn't rent for very much. So if we're going down the path of what's the best property to buy as a house land that will help our debt servicing calculation, we're looking for properties that have a reasonable size house, that has a reasonable size footprint on the block, that gets us a reasonable amount of rent for the value of the property. Now, as we think about that high amount of land, low amount of property, we're looking for a balance whereby our land content is enough to give us good capital growth over time, but also and not kill us with land tax and high rates. And the thing that sits on top of that block of land is a reasonable style property that will give us a good amount of rental return. If we can find that sweet spot, then we'll find the property that banks want to lend you a high loan to value ratio against, but also will enable your debt servicing calculation to be as strong as possible. So it really all comes down to growth, liquidity, and what you're trying to achieve. There is no right or wrong. If I offered you 2 properties and one of them was a owner-occupier style apartment that was in a beachside location in a major capital city that had low strata and good income versus a house that was in a more regional location, right? That was a smaller block on a smaller house on a bigger block of land, you'd probably take the apartment over that house any day of the week. By the same token, if you offered someone a house that was a 4-bedroom home on a reasonable sized block of land within 10 k's from a CBD of a major city versus a very high-end, high-rise apartment with massive strata that might be located in a more regional coastal town, then once again, you'd probably buy the house over the kind of holiday lifestyle type property. So it comes down to the underlying math and numbers, the underlying demand for the areas, the underlying rental requirements for that type of property in that area, to guide yourself into which one of these properties is going to be best for my portfolio, which one of these properties is going to be best able to suit the needs of what I'm trying to accomplish, and then make your decisions and go from there. Certainly for many investors, they definitely start with apartments as their first purchase. It gets them into the market. They have a lower barrier to entry. They have better returns, so long as we select the right one, and it fuels their debt servicing calculator to go on and do other things. As clients get further down the track, then they start to look at more house and land packages, and eventually might migrate into those kind of very high capital growth land banking opportunities, where they might be purchasing houses to develop later on or sell off to developers. So there is a transition here. Everyone kind of starts with what they can afford that has the best possible returns for them, and then migrates their way away from yield into high capital growth. It's all in stepping stones. So there's no right or wrong. What there is the right property for you at that point in time, and how that property fits in to your long-term goals. So if you'd like some help running the numbers and seeing, based on your current properties, what your next property should be, we can have a look at what you've currently been doing. We can have a look at what you think you want to do in the future, and we can see if those two marry together. A fresh set of eyes never hurts. So as always, like and subscribe to our channel, and if you'd like to have a chat with someone, there's a link below straight to our calendar, and we can organise a time to catch up and have a chat.